used to discuss that a lot. I did a little bit more hands-on mentoring, a little bit earlier in my transition from the military into this, and worked with several people that were doing mentorship programs, and they would ask, what I need, what do I do, what's next, and there's always an opportunity to do a mentorship, and those things can get costly. It depends on the person, what their base is, what their background is. Education level, what they did, right, to get to where they're at. And it also depends on personality. If you're dealing with a personality that is, risk averse, they need to be motivated. They need a kick to kind of get going. Maybe I would say for those kind of folks, and I would ask them specific questions to get a sense of what they were like.
Welcome to the Yacht Captain Investor Podcast. I'm your host, Scott Kidd, where every week we dive deep into conversations with real estate pros, business owners, and maritime professionals about their mindset and journey to success. Please help support us on our journey and our channel by liking, subscribing, and commenting below so we can help you in your journey to success. How you doing today? Scott Kidd, the host of the Yacht Captain Investor Podcast. I have my good friend here, Ray Reyes. How you doing today, Ray?
Fantastic, Scott. Good to be on.
Well, thank you so much for taking the time. For the couple of people that don't know who you are, why don't you just give us a little intro about yourself?
Let's see. 28 years in the military. I was raised in Milwaukee, Wisconsin. I'm down in Florida right now. It's almost as cold as it was in Wisconsin. I don't know what the heck's going on here with the weather, but and really just after getting out of the military, just focusing on something I've always loved, which is real estate, and doing real estate in multiple ways. The only hard rule with real estate is buy right. Yeah. You do that, then just about everything else works. There's better ways to scale in some cases, but you make money if you just buy right. I'll keep it short, Scott. We'll get into it, but really, this is something I've always loved. Monopoly's been my game forever, and
me too.
It's in the blood, man.
Yeah, me too. My favorite game when I was a kid, and still is today. I know we were discussing the other day when we had coffee, we were talking about your fund and everything. What was your path to deciding to go from just a real estate investor to fund manager?
I think the biggest thing for me is I really enjoy traveling. And if you are actively involved in managing assets, that requires you to be somewhere, sometime, and handle, emergency situations. And you don't have to be the property manager. You can be a property manager and okay, I got a property manager. I don't have to worry about that. Wrong answer. You will, and you will get involved no matter if you have a property manager or not. In fact, because you have a property manager, you probably need to be more involved because the property manager is not, how do we put it? You guys, they're working with us, so you have to pay even more attention. So that was kind of my thing. I got out of that because as a fund allocator, as a capital allocator in a fund, better said, we work with the right operators who are then managing those property managers and obviously managing those assets and owning those assets. You have to. That's where the focus is for me, is making sure that we're in the right deals with, more importantly, the right operators, because a bad operator makes a good deal go bad.
So most definitely. That's something that's the best tip that I ever learned, and that's the best tip. If anybody's listening, hear those words and repeat those words. A bad operator will make things go really bad for you. And I think that's a very important point too. Is just because you have a property manager doesn't mean you're hands off. You have to manage the property manager, and if they start doing doing things wrong, or you aren't hitting the targets that you want and the KPIs and everything that you want, you might have to be there. You might have to just show up over there and walk through the property and maybe re-explain everything and go everything. It's a lot more active than you might think. And being a fund manager is not necessarily passive either. Maybe when I get into a little bit of that, of the ins and outs of being a fund manager and the activities that you do, because some people think, oh, I'm a fund manager now. They think same thing like when they got into real estate. Oh, I'll just get the mailbox money and everything's gravy and I'll go sit on the beach.
Yeah, I think the biggest difference is time and space. As a fund manager, you get to pick when you're involved in things, because there are essentially two layers of people that are involved in potentially day to day, right? And so as fund manager, you just one more step separated from that. But yes, you are still involved. I would say that you can own a fund and be called a fund manager, but you're sort of the fund manager, and then you have an administrative staff that manages the internal workings of the fund. And they're two different things. I mean, you can be a fund manager and have people do everything, and you're just an owner, right? And you're just at that level. But if you're not at the level and you're getting started, you're doing a lot of that administrative stuff with your either yourself or with a small team. So it just depends on where you are in the fund.
Yeah, I know you have to have admin, running the fund, and then you also have to raise capital, and you also have to do the asset management as well, to kind of overview and everything. So there's a lot of things more that goes into it, and and I'd like you to repeat like some of the questions that I know you ask the operators. What are some of the first questions that you ask the operators?
Yeah, I want to know how many deals they've done. I want to know, how they communicate with their investors. So they have direct investors. And I want to know, probably one of the first things I ask them is, what's your record, basically? I mean, at the end of the day, we're going to find out, right? We're going to find out if they're really good operators or not, because the next step in me asking them those questions is then getting a full background on them. And they know that up front, like, hey, we're gonna run a background on you and your entities that you're involved in. But before we get to that, before you spend money on helping me run this background so I can provide you capital, tell me what's gone good or bad. And let's face it, if you're in this space for a while, you will have had issues. There's just no way around it. I don't think there's anybody out there. We've worked with some large institutional funds that have lost assets and have done that. Things haven't gone well. That is it's kind of washed away because it's in a portfolio, and that's the way you have to look at these things. Same thing as if you're if you're in a stock market. Mm-hmm. And have an asset that, a stock that performs extremely well, and then you'll have some that don't. But at the end of the day, what is your total investment look like in that market, in the stock market, for example, right? Or even if you have index funds, are they high growth funds? Or some of them are basically just mutual funds? How are you doing overall? And I think you have to kind of look at it that way. And I mean to say that when I'm talking to operators, I'm not expecting an operator to never have had issues. That's not real world. That's not the way the world works. If you've been doing this a while. But I do expect transparency, and I do expect them to have learned from the mistakes that were made. And if they're making the same mistakes over and over, that's a big flag.
Yeah, most definitely. I would add, when you get involved with these operators and you're talking in those discussions, I know that for me, in anything I'm doing, transparency is key. Like if they come forward and say, yeah, right now we got a couple of properties that are not doing well, and right now there are people that have properties like that. They're upfront about that, and we're doing this, and this, and our plan is this. And they're not doing any capital calls or anything like that, or hey, we are doing a capital call, and they're upfront about it. Then, when you do the background check, if you do go forward, you're going to, okay, well, they did these. They mostly had all these, but these were the only two that they had, and they're kind of having issues. And like you said, it's not real world for anyone not to have any problems. I don't know of anyone that that doesn't have any problems. It's not realistic, and it's just something you really that we I know we've had this discussion before, is vetting the operator and vetting the partners and the team and the people that we're involved with. That's the number one thing. I mean, because you could have the best deal in the world, the best fund in the world, but if you have a bad team, a bad operator, bad management, yeah, you might as well just write it all off, because it's going to go bad at some point. Well, what in your fund? What's your? I know we talked about a few different strategies and a few different asset classes that you're thinking about adding to the fund, because I know majority of your background is in multifamily. What other things and asset classes are you looking at?
I really like, I want to call them health real estate investments, meaning that the underlying operation of that is happening within that real estate, the piece of real estate is medical or dental. Why is that? It's very similar to multifamily. We need a place to live, no matter what, right? I mean, there are some very unfortunate people that don't have anywhere to live, but the overwhelming majority have to have a roof. Will have a roof over their head. So whether you buy or whether you rent, you're going to do that. So it's a necessity, not a want. It's not like coffee where I can decide I'm going to go to Starbucks, or no, I'm going to make my own coffee at home. It's not that way. Same thing with medical. I think at the end of the day, when things start going bad medically, or you just have a typical appointment, you have to go to the dentist. You can only avoid that so long before, necessity calls, right? It becomes one of the if you look at the Maslow's hierarchy of needs, when stuff starts hurting, that's going to take priority over a lot of other expenses. And it is. And so when I look at it from an investment standpoint, that's what I like. I'm dealing with something that is not going to go away because we're in a good economy or a bad economy. At the end of the day, people will go to the hospital, will go to the medical clinics and dental clinics.
Yeah, and we love them too. We're developing a few of them ourselves, and they're very stable, strong assets. They're not quite as dynamic, but hey, boring is great. I love boring. It's it doesn't need to be flashy or fancy, but for me, it may be boring to someone else, but it's exciting to me when it gets stable and it's a triple net lease for 15 years. I think that's to me that's pretty exciting, because one, it fills the need for the office to be there, and it also fills the need for the investors and the clients and patients that are there. Are you looking at any other types of assets? I know we discussed some type of cash flowing, potentially some debt options as well that you were looking at as well.
We are looking at some debt options. As part of my internal portfolio, I do some private lending, and I work with fix and flippers that are out there doing rehabs of single family properties. I do that within my solo 401k, simply because from a tax perspective, that is a place where I am not going to get hit with additional income for tax purposes, right? So it's part of my retirement. So I like that, because essentially when you're doing fix and flips, you can make good money doing that, but it's going to show up as income. I mean, typically done in less than a year. So you're talking short-term capital gains. You just treat it very close to just regular W-2 income. And that's not what this space is about. It's about, how can you invest and keep the majority of the money and not just give away to Uncle Sam, who's going to do whatever it wants with it, whether it benefits you or not.
Yeah, that's a whole nother discussion of where the money goes.
Yeah.
Do you use your self-directed IRA for that?
I don't. I use a solo 401k, and simply because I have real estate businesses, so I do the business. If the business aspect of it on a solo 401k. I have some IRAs, but self-directed IRAs It's kind of duplicative if you have a solo 401k. And there are some advantages to a solo 401k as it relates even to taxes. There are some potential tax liabilities. They're not great on a self-directed IRA, and some people have found ways to get around it. But at the end of the day, if you have leveraged gains, you do have to report that if you have a self-directed IRA, and that could count against you, because essentially you're lending money for a third party and you're just an investor, but you're making money on essentially arbitrage, because you're lending, they say 60%. Your money goes towards 60% of a deal, and you're making profit on that 40% that somebody, the money's coming from elsewhere. And so that 40% is it's leveraged, which means that any profit you get from that 40% comes back to you as a potential tax liability. And so it's not as bad as the entire thing going against you, but it is a little bit worse. Whereas in a solo 401k, we don't have to worry about that.
Yeah, and I guess if you're doing the notes as well, it's just it's a little bit different as well. Whereas if you're buying a property, there's a whole nother tax liabilities there as well. But I personally have a Roth IRA, and I've been looking at doing that for quite a while. Just haven't dedicated the time. But I know there's a lot of different little nuances between solo 401ks and Roth IRAs. Is your solo 401k, is that pre-tax money?
You can have both within a solo 401k. Essentially, so I have some that's Roth and some of it that's traditional within a solo 401k. So I actually, you have multiple accounts that way. But it's just the way the money's qualified, and that it's business related. It's business related retirement account versus just a simple one. Because what that means is I'm not only the employer in the business, but I'm also the owner of the business. So because of that, there's some unique advantages.
I see.
I would ask people that are interested to really work with those professionals, right? There's people
definitely.
Don't take my word for it. There are people that's their job.
Neither of us are financial advisors or pension plan people. So seek out your advisor, because if I know there's a lot of different little nuances, and there are other advantages to this that we are not 100% on ourselves. So definitely seek those people out. But mine is a Roth IRA, so it's a post-tax. So technically after that, there shouldn't be any tax on it when I start drawing against it. And if things like that, like debt funds and stuff like that, are great because it's just a fixed income and it just keeps turning over. Whereas a lot of it now is in stocks or what have you. It could be in all kinds of different things. And as far as I know you invest personally, you do some invest in some hard money and stuff like that. Is there any other real estate that you like to do personally or as a fund manager that you look at in today's environment that you're seeing that could be some good opportunities there?
On the residential side, I think what I'm really looking at, and a lot of people are paying attention, is that we've kind of hit the peak, and we're already the trough, if you will, and are coming back up. The problem with multifamily is, it got hit with a lot of things at the same time.
Yeah.
Unfortunately, because number one game in town, the market. And maybe post-pandemic, houses are too expensive to build. Developers went all in on multifamily. And so now what that meant is that you drove into a lot of excess supply in good markets, because demographically they're good markets. You have population growth, you have a lot of good things going on, but it was just too much of a good thing. And so anytime you create an imbalance in supply and demand, it's gonna hurt. But I think, for example, I like Dallas a lot as a market. I like Dallas. Dallas is great state, a business friendly state, and there are very much unique advantages economically, and population growth continues. Dallas is just huge. And so what happened in Dallas? Dallas had a lot of, in fact, up until I think this last year, their number of deliveries onto the market were one of the highest in the country.
Yeah.
Not just from a volume perspective, because obviously Dallas is huge, but just even from a percentage perspective. Mm-hmm. And so that absorption takes a long time. And absorption means people move into those units and burn it off, lease them up. And so, but what also happened is because there's been some slowdowns in multifamily, now you've got scarcity where developers haven't built anything for the last year, and even these next couple of years. The builders are not building, and they're not building single family, and they're not building multifamily.
Yeah.
And so what's going to happen? You're going to find again an imbalance of supply and demand, but in this case, it's going to be beneficial to multifamily investors. I think investors, and I would tell anything to the folks that are listening here, stop paying attention to the dramatic news that you see day to day. They just want you to read, and it's clickbait.
Clickbait.
Pay attention to the institutional money. See where it's going. See where it's going, and that's where you want to be. It's it's almost the more blood there is in the water, the more the opportunity, because people just pull back. And I get it, especially if you bled a little bit, you're like, oh, I don't want to bleed again. But unfortunately, that's when the money is made. Like again, as I mentioned at the very beginning, if you buy right, a lot of things work. So right now there are some opportunities in Dallas and other markets that we want to capitalize on. So I think that to me is a focus. Now, whether I'm looking at other things outside of the medical aspect that we talked about or multifamily, I'm not personally doing that. Now, close by, nearby, if an opportunity comes up on, say, somebody needs to sell a house or whatever the case is, my wife's an agent and we can handle those things and do referrals and do short-term, quick-turn cash flow plays. Because, multifamily takes a while, right? It takes a while. No matter what you're doing, you put money in, especially if it's new development. It takes a while to lease up. It takes a while to cash flow. So if you need cash, that may not be the place to be. And not if you need cash, immediate. But if you're trying to grow your wealth and you can park that money in a deal for 3, 4, 5 years, get the tax advantage, then now when that property sells and you exit out, there's a substantial, growth there. Again, assuming you buy right.
Yeah, well, that's a great tip for the anybody that's listening, is that that multifamily is a slow moving machine. That all the problems started happening a while ago, and it's going to take a while for it to play out. And in Dallas, you did see a lot come online, and I know a lot of that was because we're heavily betting on Dallas as well, because I shouldn't say bet, I should say. Working on projects in Dallas we're not Vegas or anything like that. We've done our calculated risk assessment, but a lot of that was on the north part of Dallas. A lot of that came on, and a lot of that has been absorbed because, like you said, the developers have kind of slowed up a little bit because of the rates and the inflation and a lot of the other stuff, and their labor is starting to get a little. Not scarce, but there's a lot more competition for labor, especially in the construction field as well. But we love Dallas as well. It's a great thing, and I see in residential, you see a little more stuff coming on the market in some markets and stuff. And I think like Austin, especially in multifamily, that's still got a little bit to go to get absorbed. San Antonio, I think, is doing quite well. But they will probably recover faster because their median income is a little bit lower, and they're more in the workforce housing and stuff like that. And so it'd be really good to, it definitely won't be dull, but we love the Texas market and as well. And both of us being in Florida, and you're right up the road from me, there's a lot of people actually moving to our area, and they're moving out of the down south or further north to move here. So there's always those kind of things to remind everyone that it's a local game. It's where the jobs are coming, and then the people come. The population will create all the rest of that. And then what advice would you give to, say, someone that is just potentially getting into commercial real estate and stuff like that, and wants to kind of get their feet wet? What would you suggest for that?
Yeah, that's a good question. I used to discuss that a lot. I did a little bit more hands-on mentoring, a little bit earlier in my transition from the military into this, and worked with several people that were doing mentorship programs, and they would ask, what I need, what do I do, what's next, and there's always an opportunity to do a mentorship, and those things can get costly. It depends on the person, what their base is, what their background is, education level, what they did, right, to get to where they're at. And it also depends on personality. If you're dealing with a personality that is, risk averse, they need to be motivated. They need a kick to kind of get going. Maybe I would say for those kind of folks, and I would ask them specific questions to get a sense of what they were like. I say you may want to do a mentorship program because you need to have that pressure put on you. And so that's one. But then you have other people that they're go-getters. They worked in business before. This is just something different, or maybe they did real estate before and single family. So figure out who you are. Figure out what is it that's going to get you to the next level, and then focus on those things that you need to get there. Some folks, I would tell them, especially if they had the right background, I would say you may just want to get in a couple of passive deals. Just to get a feel for it. Get in a couple of passive deals, because what a mentorship will do for you is it'll give you a network, and then in the space, right? And so you can ask questions like, I need a lawyer that can help, commercial real estate. Who do you know who can help me? Or I need a CPA that is, real estate friendly, that understands how to get the max advantages from real estate as it relates to my cutting down my taxable income. And so those in the network will be able to give you those recommendations if you do a mentorship. And in some cases, they'll help you analyze deals, and they'll help you with other things. Same thing if you go and invest in a deal, that deal that you're invested in, if it's with the right operator, the right partners, they'll give you a network too. Because you're investing your money in that deal, you have access to information about those specifics. And you have other people that are putting their own money in play, that are analyzing the deal that you're looking at. And essentially you get to a similar end state through different means. So I guess the biggest difference is when you do a mentorship, you're paying money. You don't necessarily get a return on that investment, tangible return on your investment. You get obviously the education. If you invest passively in a deal, you're getting that education by on-the-job training, if you will, but you're also getting some return on that money because you've invested, and you are now a limited partner in that deal, and you get that. So it depends. So I would say that's the first thing is figure out who you are, figure out what you need to get to the next step, because too many people. And I talk to them over and over, and they're like, I want to do real estate, Ray. I want to do it, And, we have these long conversations. At the end of the day, we have the same conversation the next year. And it's like, what? I told you what you needed to do. Like, do something, right? Like, and you just get stuck on neutral. So, from a military perspective, I would say, don't mark time. You got to take a step forward. Figure out where you need to go. Get the guidance that you need, and then move out. And so that's I think the biggest thing that I would tell anybody. People are going to make mistakes. You be careful that that you don't make huge mistakes, but you don't learn if everything goes well. I mean, there's no learning involved there, right? It's and so learning happens when things get difficult and get hard. So that's what takes you to that next level. And I think that's the biggest. The same thing. Your point is, it's not overnight.
No,
it's not overnight. You're gonna have to grind a bit. And I get people that that they retire from the military, and it's like, Ray, I want to do this. And we start working. I had one partner. He's like, Ray, he was bugging me. He's like, Ray, I want to do a joint venture with you. Let's do a deal. And finally something came up, and we were able to get on a deal. Not 2 weeks into creating the LLC, he goes, you know what, Ray? I'm going to do something else. And it's like, okay, dude,
yeah, we're tied.
This is people's time and money and effort. You just can't decide, one day or another you're going to do something different. I guess he did. But at the end of the day, if he ever tries to come back into the space, he's burned, because nobody wants to work with people like that. You gotta have some resilience. You gotta want it.
You gotta commit. And I would add to that really, because I know what I struggled with for a while when I wanted to get into real estate, is just really finding that clear vision of what I wanted. I know it evolved over time, but it was really, like you said in the very beginning, figure out what you want to do. Because if you don't know exactly what you want to do, just kind of take the time and keep getting educated and learning about all the different things, rather than going and jumping in full. I mean, some people are really good at jumping out of the airplane and building the parachute on the way down, and everything works out for them fine. But that's not most people. But just figure out what you want to do, get educated, find people around you that are already doing it, and just ask them some questions. If they'll answer, they might just tell you all the mistakes that they made, and that's a big jump ahead for you. I know it has been a big jump ahead for me, because most people, a lot of times, especially in real estate, they'll tell you some of the wins, but what they really get into is telling you, what happened this time was, when this building went like this, or we had a fire in the medical office or whatever, and everything else. They'll tell you the problems, and that's what brings us success, was those failures, because you can't have success without those failures. It just doesn't happen.
It's true. One thing I would add is, you got to add value to people. Like if you're starting, you either have to commit some capital to a deal, you have to commit some time to a deal, some real time and some real effort, because there's plenty to do when you're doing larger commercial real estate. But don't think you're just going to call people and they're just going to want to mentor you, and while you're kicking ass. Yeah. People are busy. I'm busy. I used to be all about, hey, call me at any time, and I still do to some extent. If depending on who it is, I'll make time.
Yeah, same.
But the average tire kicker is just wasting my time, and they're never going to do anything. Not everybody has what it takes, unfortunately, and it's not that it's difficult. It just takes a certain type of personality that is willing to get up every morning and do what needs to be done.
Yeah, all things are not for all people. If you just want to learn about it and stuff, I would highly recommend that good old YouTube University. It helped me out tremendously. You can find a video on how to do anything there, and there's plenty of great influencers out there that you can follow, and they'll show you all the little ins and outs. I know I still follow a lot of them today, because they've that's been really helpful to me. And some of them I've met, that's exactly who they are in person, and that's great. Some people I've met are completely different. So I'll just keep watching their videos and try not to meet them again.
And those are for active investors, right? Those are people that want to get in the game. If you're a passive investor, then I think you still have to educate yourself, because it's very easy to fall into an idea that, just about anybody can do this business. There are people that have learned the hard way. So figure out, those folks that, are willing to communicate and give you answers to questions, and not just tell you when things are going right, but tell you when things aren't going right and how they're going to fix it. Because some things cannot be controlled. Nobody knew that the Fed was going to lose its mind after the pandemic. After they lied to folks for a year, saying nothing to see here. All of a sudden, it's like, well, you know what? We have an emergency. We need to raise the Fed funds rate by 6%. It's like, well, 6%, just under 6%. But the whole time they're trying to tell you there's nothing wrong, and So sometimes you have to educate yourself, make sure that you're paying attention to the right people. And then, if you are a passive investor and you're not sure about someone, but you feel pretty comfortable with it, what I've seen and what has happened with some of my clients is that, they'll throw some smaller amount at me, 25, 50K, and it's okay. Let's see what you do with this, right? And depending on how that goes, then they can make the follow on steps. So that way they're not over committing to any particular deal or advisor or fund manager, etc. Because it is sometimes there are differences. So you want to do that. So you want to diversify, and that's another way to diversify.
Yeah, and that'll and a lot of times they want to see how it goes with you, because the main thing is you as a fund manager, they're investing in you, and depending on you to make the right decision, because you have all those things in your fund, you've vetted all those people you're supposed to have anyway, and by you, they're really investing in you. It's not the deal, it's not the assets, it's your experience and your they want to know that you're going to go all the way, and if there's something goes wrong, you're going to go and sort it out and figure out what's the right thing. Here's one I was just thinking about is, what advice would you give to someone, say an entrepreneur that potentially just had a big exit and wanted to deploy some into real estate? Commercial.
Well, great question. They're probably going to have a lot of different opportunities. I hope that they, before they get to that point, before they do the exit, that they've already started looking for pathways. Mm-hmm. It's kind of like doing a 1031 after it's too late to do it. Okay, well, I can't do a 1031 exchange. I already sold my property. But so I think if somebody's considering that, and if it's a large transaction and they're going to make significant profit, then they probably need to get the right kind of advice. Now, some financial advisors will not talk to you about real estate because they don't get a commission if you invest in real estate. Yeah. So they're going to tell you, hey, invest in this fund, invest in whatever, because there's no advantage to them. So they're gonna forget that. So keep that in mind. I mean, what's in it for them? Yes, everyone's in this to make money. Nobody's doing this for free, but make sure you get robust answers to your questions, not a one-sided answer that's only beneficial to them, and not potentially to you. I would say there are different ways that you can put your money into some mechanisms for tax benefit. There's DSTs, or Delaware statutory funds. I was just talking to a partner of mine who's getting very educated in that, because essentially it allows you to use that fund the money that you put in that fund, and it's tax privileged money. So then you can take that money, you put it into this account, and then you can invest in multiple different deals. Mm-hmm. Tax advantage perspective, very, very similar to doing a 1031, because essentially you're taking your profit and then you're reinvesting that same profit into something. So there are ways to kind of convert that money from a tax advantage perspective. So there are ways to strategize that advisors can work with them on it. I mean, it's a good problem to have that. Hey, I have a taxable event. But at the same time, you want to maximize those, right? Because they don't come every day, and so there are ways to do that that would advantage them. So if you know somebody, Scott, that is about to sell something, they're like going to be coming into a whirlwind of money, they need to reach out to several folks to get advice about what's the best way to deploy it before they have it.
Yeah, I would say the sooner the better, because that would really. It'd really be tough, because then you're kind of against the clock's ticking, because if you did it now, you still have to probably deploy it into multiple things before the end of the year and stuff like that. And then there's, you don't want to have to put it into something, because then you're probably not going to make the most effective decision. But that's a great advice, because I get that question sometimes, because, a lot of people are winding down businesses and selling them, and they don't know what to do after, but they do want to still have some kind of continued income as well. But This has been really good and really great having you on here. Is for people that want to get a hold of you and find out more about your fund and what you're working on and you in general. What's the easiest way for them to get a hold of you?
Yeah, I think the easiest way is to go to my website, ismaelreyreyes.com. They can schedule a virtual coffee with me for 15 minutes. Again, just tell me what it is. If you're selling me something, I may or may not, have the meeting. But if you have, true, hey, I have, real questions, and here's what I'm trying to do. That's exactly the kind of conversations I like to have. We keep them short. I love talking about this stuff as time permits. Yeah. So I think that's the easiest way. Just get on the calendar there, and then we just have a short discussion, and then from there, you move on. Sometimes I talk to operators, and they want to get started. I'm happy to have that first discussion with them. They want to have a second discussion with them. I may charge them because at that point, my time is money too, and I'm not, selling people mentorship programs, but my time is valuable. If you're an investor and you're looking to, figure out how, what's a good way to do it, we can talk about it. And it may not be that I'm the right person for them, but I can give them direction and say, hey, here's something they want to consider. Like I mentioned, the DSTs, there are DST managers that manage that money. They get a commission on the money that is deployed to there. It's tax advantage, but they have to manage that for you. So there's some money there. So there are some opportunities for other people to make money, and I'm happy if that's the best case scenario for them.
Yeah, that's great. Great words of advice there. And if you want to consult with Ray, feel free to reach out. If you're an investor, find out what Ray's working on, or another syndicator. But thank you so much for being on here. I really appreciate it. It's been great, and I look forward to seeing the fund grow and seeing all the things you have for 2026 and beyond.
Yeah, I know. We've been trying to do a deal for a while, Scott. This may be the year, man.
Yeah, I'm thinking this is our year.
Or somewhere else.
Yeah, we get something going. I know we will. We got compatible thought process, mindset anyway. So I really appreciate us always keeping in touch for so long. But we'll probably, what we'll do is we'll do this podcast. We'll do another follow up at some point and see where it's at. Hopefully we'll be doing something together. That'd be great.
All right. Well, to a successful journey that hopefully doesn't start and stop at the same place.
Well said. Well said. Well, I'm Scott Kidd, the Yacht Captain Investor Podcast. Just a reminder that the best investment you can make is the one you make in yourself. So invest heavily in yourself. See you next time.